One of the most sold off stocks, Alibaba, just reported their Q2 earnings and the stock actually popped 7% today from the morning session. We're now sitting at a market cap of 223 billion, a PE of 40 and a free cash flow yield of 4%. So with Alibaba being Amazon's largest competitor with over 500 million consumers, what do we as value investors make of this business after this earnings release? And should we be buying into this stock now that we are down about 72% from those all-time highs back in 2020? Make sure to stick around to the end of the video as we answering all those questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, today we will go through the fundamentals of this business, the top line, bottom line, balance sheet, cash flows, etc. Finally, we'll end up concluding with an analysis of this business using our intrinsic value calculator to see the buying opportunities with this stock. And if you do enjoy these types of videos, make sure to subscribe because we post on here regularly. Also, make sure to comment your video recommendations so we make sure to cover the stocks that you're most interested in. And if you do enjoy the video, give this video a like as well. With all that being said, let's actually just jump into the analysis. All right, and this is the September quarter 2022 results for Alibaba here. Let's start off by going through their segment results. We'll go through all the different segments that they do actually have. Obviously, they're operating in a bunch of different ones, so we can really see why this is a big business and one of Amazon's biggest competitors. But we can see for the consolidated business, they had about 207 billion RMB in terms of their revenues. Okay, 135 of those 207 billion came from China commerce. That's their biggest portion of their business. We'll get into all the details of the rest as well. Some segments are growing nicely, some of them are actually declining as well. So again, we'll talk about that. Before we do that, take notice here, this innovation initiative segment of their business really struggled this quarter, down 45% in terms of revenues on a year-over-year basis. Yeah, it doesn't look too great. But with all that being said, let's start with their China commerce business. Okay, what exactly is this? Well, it's their revenues from their China commerce retail business. Okay, so they have a bunch of different businesses. I'm not going to try to name all these, but we have Taobao, Tmall, etc. And for this quarter, we saw a decrease compared to last year of 1%. So relatively flat year over year, no growth, which is both a positive and a negative because we have seen very harsh conditions out of China right now. They're still going through a lot of lockdowns. People are not spending so much. And they're saying this is a result of customer management revenues declining by about 7% year over year, mainly due to the single digit decline of online physical goods generated on Taobao and Tmall. Again, we had softer consumption demand with a COVID resurgence and restrictions. All right, their direct sales actually did increase about 6% year over year. That leads us into their international commerce segment, okay, where we have AliExpress and Alibaba.com. Okay, these actually had an increase year over year of 3%, so still relatively flat, but we're seeing an increase overall. That's always something we want to see, especially when we've seen a ton of revenue declines over the past few years from this business. Okay, the increase was due to strong order growth from its e-commerce business and more efficient use of subsidies, and they did also have some currency impacts as well. International commerce wholesale, this actually had a 6% increase as well. Next, we have their local consumer services, where we saw a 21% increase in revenues year over year. Next, we have the K-Now business, which is revenue from its domestic and international one-stop shop logistics service and supply chain management solutions. Okay, an increase of 36% in terms of revenues, a substantial increase from last year's results. Okay, they also have Alibaba Cloud and DingTalk. These revenues had increased about 4% year over year. They also have their digital media and innovation business. Okay, so let's talk about digital media first. This increased about 4%. And again, when we get to our innovation segment here, yeah, these actually had a massive decline here, almost 50% year over year. And they're saying the decline in EBITDA is mainly because of their investments in technology and innovation. And so when a business has so many different segments and they're devoting a bunch of cash into building up new businesses, it is expected that they are going to struggle, at least while the innovation initiatives get off the ground. And also we have to recognize that this business definitely is one of their smaller segments here. But with all that being said, that finally leads us into our financial highlights. Okay, so 200 billion RMB for this quarter. If we look at this from a 6 months perspective, that actually has increased to 412 billion. All right, and when we look at this from a 3 months perspective, their income from operations is now up to 25 billion RMB, an increase of 70% year over year. large increases. We'll get into the expenses in just a second. Ultimately, on a 6 month basis, a 9% increase to 50 billion renminbi. And so while Alibaba has been navigating a challenging macroeconomic environment, especially in China where they've had such lockdowns like we mentioned, to see increases across the board in terms of fundamentals is a great sign. When we get down here to our costs of revenues and operating expenses, we can see they're actually maintaining these at about 63% of revenues. So costs are not increasing while revenues definitely are. It's ultimately going to help out our margins here. Same thing with our product development expenses. These are actually declining now in terms of percentages of revenue. Same thing with their sales and marketing expenses. Those were at 13% last year. Now they're down to about 11%. So those are coming in a little bit. That's definitely a good thing to see. And the same thing across the board for SG&A as well, right? So expenses as a percentage of revenue are staying flat while revenue is growing. It's definitely going to lead to positive impacts, especially when we get to our income from operations here. Again, that 68% year over year increase. On top of that, they're also decreasing their share-based compensation expense. That's definitely what I want to see when a business is going through hard times. They definitely need to cut back on costs to get them back to where they used to be. So that's a positive for me. The unfortunate part is that once we've deducted for our unrealized losses and gains, as well as our other expenses, we're left with a $3 billion net loss. And again, these are from their losses in market prices of their equity investments in publicly traded companies. So take those results with a grain of salt. I mainly look at income from operations anyway, but it's just there for some context. Finally, we'll get down to our cash flow and balance sheet segments. Okay, looking at our cash and cash equivalents, if we look at this from a USD perspective, we have about $29 billion in cash, $38 billion in short-term investments. When we get down to our debt position, only about 22 or so billion dollars worth. So we have a net cash position of 51 billion US dollars for this business. Okay, huge numbers. Okay, when we get over to our cash flow side of things, from a 6-month perspective, we look at our cash provided from operating this business, we have about $11 billion. Deduct our capex and we're left with about $8 billion in free cash flow from the 6 months so far of this year. 5 billion of that was produced actually this quarter. Again, finally seeing growth year over year. They do have a massive cash position on the balance sheet. They're repurchasing shares now at a high rate. 5 billion so far spent on repurchasing stocks. So they're really expecting this business to rebound from these levels. In their eyes, the business is way too oversold. And honestly, I might be of the same thinking. Now it's time to do our competitor analysis. And if we just bring up Amazon's results here, I have the revenue figures. If we look at this on an annual basis, Amazon could produce about $502 billion in revenue, while Alibaba has historically been able to produce about $127 billion in revenue. We can see the disparity there. But when we get down to our margins, we can see Alibaba actually does have higher margins than Amazon on a historical basis. And that has been coming down. But again, we have to understand with all the lockdowns in China, all the impairments that they do have to this business, that number might actually rebound from these levels once we do see a rebound in the economy, at least over in China. And so their margins should improve even from these levels here. Finally, we look at this from the operating income perspective. Amazon and Alibaba both produce about $10 to $15 billion in operating income, and that's with major impacts to Alibaba's business. Finally, when we get down to our market cap, we can see the real disparity here. $1 trillion market cap for Amazon versus a $187 billion market cap for Alibaba. Of course, at the time of recording this video, it's actually in and around that $223 billion range, but still massive difference and makes Amazon stock much more expensive, especially considering at this current point in time, they're producing around the same numbers from operating their businesses. I mean, I don't know if that's telling you anything, but it's definitely telling me something. And so with the comparison out of the way, it's time to evaluate this business. We can see the growth here in Alibaba's fundamentals in terms of operating income. And if we expect that over the next few years that they can produce about $57 to $60 billion in operating income on an annual basis. Now that is in Chinese yen. So when we do a conversion, that's equivalent to about 8.5 billion US dollars. So once we plug that into our calculator, if we require a 10% return, they do not currently pay a dividend, although they are well equipped to do so with the $51 billion in cash on the balance sheet. And if we assume that once we do see a rebound in the Chinese economy, there's less lockdowns, people are spending more, that they can grow not even near their 5-year revenue growth estimates. Let's just say it's around 15% for the first 5 years. And then drops down to, let's just call it 12% for the 5 years after that on a 40 PE like they're currently trading at. The stock should be trading at about $172 per share. almost $100 off where they are right now on an average basis. Now, in the very best case scenario, let's say growth actually exponentially increases, everything from their innovation segment all the way up to their cloud business and retail commerce business all improve. We see growth of 25% on a year-over-year basis. That actually stays constant at about 20% for the 5 years after that on a 45 PE. Yeah, the stock will be worth up to $400 per share in the very best case scenario. If we look back on a historical point of view, the stock was at $300 per share just back in 2020. So with the massive growth, yeah, we could definitely see us back up in and around that level once again. And again, I have to remind you that is with $50 billion of cash just sitting on the balance sheet. But in the very worst case scenario, let's say the Chinese economy never actually returns to the way it was. Nobody's interested in investing in foreign businesses like Alibaba, Baidu, and others. You know, the business can only grow at, let's just call it 7% going forward. That drops down to only 4% on a 30 PE. Again, the very worst case scenario, the stock would only be worth $67 per share. And if we actually take a look at this, we're trading at $84 right now. This is in the very worst case scenario here, a market cap of 177 billion. Now, if we deduct $50 billion from the market cap of 223 billion, we're almost at this figure right here anyways. And the reason why I'm saying 50 billion is because that's how much cash they have on the balance sheet. So if we deduct that from the market cap, the business is fairly valued for a very worst case scenario investment. And I really think this stock is trading in and around that margin of safety valuation point, because like I mentioned, we are already down 72% from those highs. Of course, the business could go to zero technically, but they do have 500 million consumers using their products on a year-to-year basis. That's some huge numbers, and that's still with an economic slowdown out in China where they're still locked inside their homes. Now, off the backs of a recovery there where there's less restrictions, people are allowed to go out, they're spending more money. Obviously, businesses like Alibaba are definitely going to benefit from that. You know, we're still actually seeing growth in most of the revenue segments, so I can definitely see why this business has popped 7% since the morning session, as investors are probably starting to anticipate that the value will unlock with this stock. But let me know in the comment section below where you think this business goes. Are we going to see major growth from these levels? Will they ever get back to this $300 price range, or will the stock drop further? If you've enjoyed the video to this point, make sure to like, subscribe, and with that, I'll catch you on the next one.